we'll figure it out for you. But the idea of a standard deduction is that everybody is allowed to take that amount and subtract it from the income that they earned. So let's make the math really easy. Let's say it was $30,000 for a married couple, and we made $100,000. Then it's like I'm showing the IRS that I only made $70,000.
Right.
Okay. So that's what a standard deduction does for you. Is it is a deduction from your net earnings. Okay. Mm-hmm. And then so what you from your gross earnings, right? So you have your gross income, and then you get to take deductions. You get to your adjusted gross income, right? And so these are tax terms. We don't really care about, adjusted gross or this, that, or the other for this program. Just know that it's going to lower the amount of income that the IRS is going to ask you to pay taxes on. And so that's the beauty of a deduction. And some people, they're probably out there going like, it sounds like a loophole to me. It's like, so a loophole to me always sounds sort of shady.
Right.
Right?
Yeah.
This is not shady. I mean, like, let's get real straight, right? Give unto Caesar what is Caesar's, but not 1 cent more.
Right.
Right? If Caesar puts in place rules, I'm making some biblical references here, right? But you guys get it. If the government has rules in place that say, if you follow these rules, you're allowed to do it. You're not breaking the rules.
Right. Well, and if they change the standard deduction, that just kind of especially if you're doing like TurboTax, right? Like it just kind of naturally falls into the system, into the ecosystem, where it's like, this is an easy one, right?
It should be really easy. If you're even doing manual tax forms, they kind of spell out for you, hey, put a number here, now subtract this from it, and that number is the number that, the resulting number, we're going to work with that.
Yeah.
Right? And so it really holds your hand. It's hard to not screw that up. But here's where people might miss some opportunity. You may have more deductions available to you than the standard deduction, in which case it might be beneficial to take that number instead. The standard deduction is used when you don't have other deductions that are higher. So you take the higher of itemized deductions. These are the ones that you're allowed to sort of take one at a time and add them all up in a basket, or the standard deduction by itself.
Right, but with all the changes in this bill, it might actually be time for some people to go back to actually, itemizing.
Okay. Well, I suspect that there'll be a lot of people that itemize, and I'm not sure how it's going to be implemented yet, because it's conceivable that you could get the standard deduction and some other deductions right now. There are 3 things that we kind of need to talk about that showed up in the big, beautiful bill. Matt, can you, I'm trying to remember these. So, what are the 3 things? Because I think you have the notes, right?
I do, yeah. I wrote them down. So, and the reason I wanted to talk about these 3 in particular, right? If you break this bill down, there are some of them that are permanent, and there are some of them that are temporary, right? So they're only lasting, I think, till 2028, and then it's kind of gone. Yeah. So the first one of those, right, is there's this temporary deal where there's an added deduction for seniors over the age of 65.
So I think 65 or older, I believe.
Yeah.
So over the age of 65, meaning if you turn 65, you're now 65 in a day, so you're older.
Right. Yep. And so there's an added deduction there, and
I think it's $6,000 per. For an individual, I think it's $6,000 per. Is the extra
it's $6,000 per. So if you're married, you're
12, right? You get each of you get 6.
Right, but there are income limits, right? So for single filers, I think there's
75,000,
or if you're married, finally joining 150.
Yeah.
But hey, that's a pretty big deal, right? Like if you're married and you've got now an added 12,000 on top of, and I looked it up for you, it went from 27,700 to 30,000.
In terms of the tax savings?
Yeah, on the deduction, right? The standard deduction. So it's like, well, you just got, what, 2,300 more. And if you're over the age of 65, you potentially just got another 12,000 right there. So over $15,000.
That's the swing from what it used to be.
Yeah,
so
15,000 is a lot.
Well, it is, but so consider this for a minute, right? What does that kind of reflect out to, right? If you get a tax deduction, you're still likely in about the 15% tax bracket, and that doesn't mean all of it's 15%, because part of it's 10 and part of it's 15. But let's say, for easy math again, you're getting 15% of the bigger number is now savings.
Is it 15 or is it 12? on that lower end? I thought for some reason they dropped it.
10, 12, 15, then it goes to 20, 22,
you
24.
should still be in the 12% federal bracket.
Yeah. And we're not.
Yeah,
this,
we're
this
not
show's not about.
no.
This show's not about nailing the tax bracket. That's what Google's for. You can go look that stuff up. By the way, I was right. It's 31.5.
Was it?
Yeah.
Okay.
Yeah.
So they bumped it to 35.
When we're studying the notes, you have all these numbers fly by your head, right? And it's
There's
I'm
so
pretty sure
many-
that's what it is.
There's
But
so many numbers.
yeah, we have rule number 2 in our office. Don't guess.
Right. That's why. Yeah.
So
Consult a CPA or a tax professional.
yeah. And also, we should just kind of throw out what we're talking about today. This is for education, right? That we're not giving out specific personal advice for you. What we should be giving out is, hey, does this throw a flag that tells me I need to go get some help concerning this issue?
Absolutely.
It may apply to me, and if so, I better go find out.
Mm-hmm.
Right? So that's kind of what this
That's
is all
why
about.
financial advisors often work with the tax professional, right?
Oh, all the
it's like,
time.
we're like, we got to look at it from all the angles.
Yeah, and the funny thing is, we oftentimes do know what the tax ramifications are, but our job is not as a licensed tax professional, right?
Mhm.
Now, maybe there's some advisors out there that might be like an enrolled agent or a licensed tax preparer or something like that. That's a little bit different scenario. But for Matt and I in the office here, we're not formally licensed to do that. It's just one of those, hey, we stayed at a Holiday Inn Express, and I can look at the tax code just like you can.
Great disclosure. I love that.
So, but nevertheless, so look, I realize already, man, there must be a lot to cram in because I'm looking at the clock and we're
There's
already like,
no way we're at a break. We
We're
haven't
totally-
even got into the meat of this.
no,
thing
we're
yet.
totally into it. So we're actually long. So let's do this. Let's grab a break. We're gonna come back. There's so much more. I want to talk to you guys about how this could impact your taxes, like some of the real numbers. Let's give you some real examples
Yeah,
and
what
stuff.
does this deduction really
Yeah.
mean for you?
But we'll be right back. We got to run. I'm Dave Littlejohn.
And Matt Dixon.
We got True Wealth on News Radio 93.9 FM and 1240 KQEN. Okay.
Nice. We haven't even got to the fun part where we talk about, hey,
Yeah,
like, yeah, there's a deduction, but what does that actually do for you?
it's true. Well, that's the part we do want to talk about.
Good cliffhanger.
I should at some point ask Kyle too, like, how long is the break intro? Because, like when I hear the music, I should know, do I get 30 seconds or 20 seconds or 10 seconds? Dale used to kind of, like, make it, he'd kind of wing it for us a little bit. Every now and then he'd find a short
Yeah,
spot.
he'd, like,
Here's the commercial.
Yeah.
So, is it all going? It's on fire? You're like, this was stressful. I don't like it this way.
No.
Fighting the clock where you're like, gosh, I gotta do this fast.
It's like, this is the first time I've ever seen him cranky. Yeah.
The only thing that I really need to, I don't know where to even start. Getting the YouTube Live link before the live is live. So the URL that we have on the YouTube that is supposed to be the link, it doesn't take you to.
We should probably get it from
Live.
YouTube itself. There's like on our channel. There's probably a link on our channel that says go to our YouTube channel and click live. We can just describe it in the video that way.
Okay.
Because what'll happen if you're subscribed to the channel right now, it sends you a notification, and so
Yeah.
you'll get an email from YouTube going like, so and so's live right now.
Yes. Okay, yeah, that's a way better idea because I don't think we can, yeah, because the link isn't there until the live is on.
Mhm.
So Jan can't put it in the email,
Right.
obviously, because she's got to send it to work. Yeah.
Yeah.
So,
So, can we all agree that we should do some kind of testing on this outside of the studio so that we're like comfortable
Yes.
jamming on this?
Yes.
And there's a couple other things that would be really cool. One of them is we need like an alarm or something that says you guys got to leave right now, so that
Yeah.
we're not as late as we were
I can
today.
be that alarm. If you just give me the cue, I
Yeah.
will say, we gotta
Yeah.
go, let's go.
Okay,
You know?
so I think that by 20 till, because we left at like 11 minutes till,
Mm-hmm.
we need to leave at 20 till, so we're not scrambling. All right, here we go. All right, gang, welcome back to the True Wealth Radio Show. Dave Littlejohn in studio with,
Matt Dixon.
and also behind the scenes, she's not even going to admit that she's here, but Blake is helping with the live stream, so we're stoked to have you in studio with us. And she's all like, great, I don't have a microphone. But she is smiling. She's like, don't give me a microphone. Never do that. It's like, we'll see. Look, Matt, we are
Yeah.
talking about this one big, beautiful bill and all these deductions. And
we
kind
only
of,
covered one.
Well,
the show's been flying by. We
yeah.
just started talking about the senior deduction, and then we had to go to a break.
Yeah, it's pretty nutty. So first of all, if you're trying to get catch us on you can grab our podcast tomorrow at littlejohnfs.com. You can also go to YouTube. We're going to get this stuff posted if you want to watch this stuff. We're going to try to pull some of the key segments out of here too. So if you just were like, I don't need the whole thing, go look it up. We'll have some of these core tenets sort of plucked out of there so that you can look at them. But the big beautiful bill, I love the way you said it, man. It's like deductions are back in vogue.
Yeah,
right?
exactly.
So you can again get caught up. We'll explain the deductions. We're not going to re-explain it. We're just going to go. What are the 3 big deductions again?
Okay, so we talked about only one of them, which was the senior deduction, and that was up to like $12,000 of extra deduction that just appeared for joint filers over the age of 65.
Yeah. By the way, this was kind of the Social Security isn't going to be taxed thing.
Yeah, I wanted to talk about that, but then we had to go to a break, right?
Okay.
Because,
so I'll remind you to come back to the other 2. I think it's a big enough deal, and for most of our listeners here in Douglas County, I think a lot of folks are kind of like, I want to know, right? So is Social Security be taxable or what?
well, let's play this game, right?
I love it.
Okay.
It's kind of sneaky. Yeah, go on, Matt. Go on.
Okay, well, let's just play the game of you're getting, maybe $2,000 a month in Social Security, right?
Okay.
Now, help me with the math, because you're good at math on the fly, and I am not. So I haven't prepped these numbers, so I'm going to need you here. But what was the standard deduction? It was roughly about, 27, 28?
Yeah, I think the standard deduction was pretty close to 30.
Well, let's just call it 30 for
I think it was
easy math.
15 apiece is what it had kind of risen to. Every year it gets indexed for inflation a little bit, but I think it was at 30 because now it's up to 15,750. So it's an extra 750 more per person than it used to be.
Okay, right. So let's just assume for the person who is that's the only income they have in retirement.
Yep.
Say you're getting actually $30,000 a year, and so between the two of you, you're married. Your guys' total Social Security benefit is $30,000.
Okay,
How much are you going to pay in
very low.
taxes?
Should be 0.
Right, because that's 100% of your deduction.
Oh, I see the example that you're doing
Do you see where I'm going
here.
with this?
Okay, can I help out a little bit?
Yeah, go for it.
Do
you see where I'm going?
I
Because
do.
I'm saying, if we're gonna give the seniors this extra $12,000, right? How much can you now make in Social Security benefits before you ever have to even pay taxes now?
Well, so check this out too, right? First, this was advertised as we're going to eliminate taxes and Social Security.
Mm-hmm.
And everybody goes, sweet, that'll be awesome. Let's get rid of Social Security taxes. And then people hear later now, it's like, well, it depends on who qualifies. I don't even know how that's going to work, right? That's what we're about to talk about is how does Social Security become untaxable? See, politicians are notorious for speaking in partial truth.
Mm-hmm.
Okay? It's not false that Social Security is not taxable if you meet certain criteria.
Right.
Okay? Because, in fact, right now, in fact, prior to this one big beautiful bill, right? Prior to that, you could have no tax on your Social Security. Okay? If you earned below a certain threshold,
Like that $30,000 number.
your Social Security was not taxed. If you had between two numbers, it was and we're going to use not accurate numbers, but it'll be really obvious so that you know what we're talking about. Let's say if you earn $30,000 or less, no taxes. Between $30,000 and $45,000, some taxes, and then above $45,000, 85% of your Social Security for a number above that was taxable. It gets really granular because it's actually if you're in between, there's this blended taxable rate. So it's not actually a pure, you make above this, it's 85%.
One or the other. It's not one or the other. Yeah.
It's a phase out of whether or not you don't pay taxes. So the taxes get phased in over certain income levels. And by them giving an additional deduction to seniors, that deduction lowers your income, which means more people fall below the phase out.
Yep.
And that's how they're saying the Social Security becomes non-taxable. And just so everybody that is cranky about this, it really does benefit low-income people. That's who gets the tax break. Because this phase-out won't apply to people that make more money. So if you're a higher earner in retirement, your Social Security is still going to get taxed pretty much the same way because the deduction isn't going to be enough to get you below the tax threshold.
And that's kind of why I was talking about, like, what if your only income is Social Security, right? Because if you start tacking on other forms of income, say a pension or whatever, and you go over that $150,000 mark that they drew in the sand, well, it might not be, fully. You see what I'm saying? So.
Well, I do.
Yeah.
And our listeners are like, why is he just agreeing to that? Like, yeah. The issue is, they didn't change the tax code around Social Security.
Right.
They changed the way the IRS, how much the IRS sees as income. Right? By giving you more deductions automatically, since they didn't change the rules around Social Security, they just sort of bent the taxes around it.
It's a different frame up, and I think people might not have, until now, a full understanding of that.
And why does it matter so much? So it turns out they did not have the votes to make this a permanent deal. So this is going to be part of the tax provision that sunsets in 4 years, right? Parts of this bill were permanent, parts are not. The deductions we're talking about right now are available for the next 4 years unless somehow Congress intervenes and changes it.
Right.
But if no intervention, they will sunset at the end of 4 years.
Yeah, but what a big break for people who are on maybe a reduced income in their retirement ages. Like, this is a big deal. This is a big break.
It really will. And I think the estimates were very high. Like, the number of people that this was going to actually save them on taxes was pretty high. Like 70+% of people receiving Social Security, they anticipate will get some of this.
Right, and I mean, you start looking at it. There's an example in here, and whatever this example's for, but it's like, if you can, if you can stay below that $150 threshold, maybe you might save over $1,000 on your taxes.
It's about $150,000, I hope. If you only earn $150, it's like you're not paying taxes.
But that's just one of them. That's one of the three.
Okay, so there's two more. What else?
So I think this one's hit the news cycle pretty hard, right? Remember when Trump talked about, what if we don't tax your overtime or your tips?
Okay.
Right?
Once again, how do I get the air quotes out? Because my understanding about these is these have to be qualified.
Yeah, so, and it depends, right? It's only up to a certain threshold. So, like on the tips, for example, you can deduct up to the $25,000 threshold, and then after that, you're paying taxes. So it's
so Matt, what if I just didn't pay you and I just gave you tips? Is that cool?
Well, no.
What? Why not?
Yeah, like
I'm doing this on purpose, right?
Yeah.
Talk about why that wouldn't be qualified.
Because, I mean, the tips have to come from, I think the way that it was worded, those tips have to come from like an area where it's expected. Like, what was the language?
It's in industries where tipping is customary, right?
Customary,
so that's going to be things like wait staff at restaurants.
Right. So
it's
as a financial
like delivery
advisor,
drivers.
You can't change it from a salaried person to someone who's getting paid in tips. That just doesn't work.
And they do need to be reportable tips. Like, if you get cash, I mean, let's be honest, people getting cash probably weren't reporting it anyway. Right. But if you get W-2 tips, then those up to that threshold should be considered qualified and deductible. If you get more than that, right, I made $100,000 in tips. It's like, all right, well, you're still paying taxes on some of that.
Right.
Right. So when the government, when a politician, or in this case when Trump says, well, we're not going to tax tips, and it's like, what you meant to say was the whole truth, right? Mm-hmm. We're not going to tax some of your tips as long as it stays within the areas that we consider qualified. Right. That's what you meant to say, right? And then he'll go, let's talk about this other subject over here and how great I am, and we'll all laugh, right?
And then we pivot to overtime, where it's $15,000 for single people and $25,000 for joint and married filers.
Isn't that interesting that there's sort of a reduction for married? Like, that's actually a marriage penalty.
I know. I'm like, wait a minute. You could have made it 30.
But no.
So it's like, well, you can, kind of deduct some of your overtime, but not all of it, right?
Yes. So,
like, if you're working if you're working 80 hours a week.
What'll be really interesting on this one is, does the employer get to also deduct? It sounds like yes, that there's not payroll taxes or anything on that, but it's unclear to me so far.
Sure. Yeah, I don't think it really specified it how we read it, but we got the Spark Notes high-level version of this thing.
Yes. Here's here's where that also, remember, qualified. Okay, and let's just throw this out there. Let's finish this one up, and then we'll grab another break. The qualified version of overtime is, first you have to have normal 40 hours, right? So it can't be like, well, what if I, work 8 hours straight in a day, and then I work an extra 8 hours. So put in a 16-hour day. Half of that's overtime, right? So if you don't work the rest of the week, no. Right? First, it needs to be 40 hours of regular work, and this is my understanding, right? So fact check me later, but right now my understanding is you have to put in the regular 40 hours, and then it's overtime is anything that is regularly, it would be paid at time and a half above your normal wage for hours above 40, capitated at 15,000 per individual or 25,000 for a married couple.
What's interesting is both sides win though, right? Like with this overtime change, it's like, well, we're going to reward you for working more hours.
Yeah.
And then we're also, though, going to get more GDP production, right? Like,
that's the theory.
The economy wins and you win a little
There's
bit.
an incentive from a productivity standpoint. Go ahead and put in the hours. It's worth it now because you're not going to get dinged tax-wise.
Right.
So it is definitely an incentive.
We're incentivizing work again.
All right. Well, but speaking of incentivizing, we do need to take a break here because this station is incentivized to stay open. So we need you to listen to very important advertisements. And then stick around. We will be right back. I'm Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 92.9 FM and 1240 KQEN. Okay, are we having fun yet?
So much fun.
Are you freaking out over there, or are you just bored?
No, I'm fine.
You're like watching. It's only 2 people. Why is there only 2 people?
Oh yeah, does it say? If you go back to YouTube instead of OBS.
Yeah, in theory, you could stream this remotely. Like if we set all this up, you could log in as the administrator from the office if we had it all here, and you could answer questions and things.
Oh, yeah.
Mm-hmm.
Yes.
Oh, there is a chat, yeah. It'd be awesome if our 2 listeners would chat in.
I think
What if
the
they
2
work for
listeners
us?
are me and Jan.
Yeah.
Could be. It very well.
Because I'm viewing right here. I have those. There we go.
But I have every confidence that you're going to help us
Okay.
parse this into finding the little gems and nuggets, because you're probably taking notes in your mind right now about that one will be good. I'll use that one and that one and that one.
Yes.
Yeah, lie to me. It makes me feel better.
Here, I brought you a pen, and
Yeah. Yeah.
I actually was gonna. I was gonna look for some paper, but then I gave up because there's not any around me. But I wanted to. Oh yeah, Jan said I'm watching. Message. I wanted to make a somewhat of a procedure so that I remembered what we did, so that we can test
what
it out.
buttons to click.
Yes, exactly.
Yeah.
The
Well, I
exact
think that's
buttons.
good. And I do, Matt, like let's all like make a concerted effort to like try to measure this before we leave today. Last time we were just like, great, let's get out of here. Like, let's make sure we kind of measure up how we want to deal with this so that it's easier.
What do you mean?
I mean, if we're going to change the way that we mount cameras in here and put
Oh,
something
okay.
in,
Oh,
let's
oh.
get the measurements so we know what we're trying to build around.
Physically, literally measurement. Okay.
Literally measure.
Yeah, we're talking about getting like a bar that goes across
Yes.
here, where we can hang a camera.
I think that's a good idea.
I think we could probably leave it in here. If we got something that, we could just, we'd probably take the cameras with us, but it's like, if they're on clamps, it's like click, click, done,
Yeah.
We can make a quick connect, disconnect situation with these.
Yeah, because
Hot
sometimes
feet.
like Justin and I have been here, and then we're like, oh, David's got the tripods in his truck, and
Yeah.
What'd you guys do? Not record it?
correct.
Oh, okay.
Yeah, great podcast.
Yeah.
One of the best. Yeah.
I watched that. It was really good.
You've watched the podcast with no video.
Mhm.
That's remarkable. You're very, very attuned. Yeah, there needs to be, so there's a procedure after too for like putting this, we need to get the audio and then throw it into the Notebook LM system because it's tracking everything, so we can go like, what topics have we covered in the last 3 weeks, and should we bring something back in, or we could go look and say, do we have content somewhere? We got all these old shows. You could say, I'm
Yeah.
looking for a video on rock conversion. It's like, oh well,
Yeah.
This marker did it.
My buddy Brad just texted me and he's like, "Hey, you guys are killing it on the radio today. Keep up the good work.
Nice.
Thanks for explaining the bill."
All right, gang, welcome back to the True Wealth Radio Show. Dave Littlejohn in studio with
Matt Dixon.
They tell us like there's some way to come back from a break, and we just make that up and use our names over and over because you guys listening, right? You totally care about our names, right? No, it's like,
no.
Please get to the goods,
They're like,
right?
get to the stuff that I need to know. We're talking about a bill. We want to know more.
I'm just a bill.
Oh, gosh.
Sitting on Capitol Hill.
Please
Sorry.
tell me you realize.
Yeah, Tim Matt's over here like, and I quit.
I remember that one vividly, and I'm looking over at Blake like, do you remember this one?
No, that is before she was born.
Yeah,
like,
I think
that's,
yeah.
No, that's Schoolhouse Rock, which you missed out.
You really did.
You know what?
Catch
We'll
on.
show you the YouTube later. So, honest, like your generation will one day appreciate badly animated explanations of civics.
Or they'll just never watch it and boycott it altogether.
Yes. So anyway, we're talking about the big beautiful bill.
Right.
We've talked about how there are these three sort of surprise deductions that are not surprise, but they're just new. Right? There's new. So there's a deduction for people 65 and older on top of your standard deduction, okay? Which another $6,000 per person, right? We've talked about how there is the possibility of being able to have deductible tips and deductible overtime, which would in effect reduce your tax exposure for either of those.
Yep.
Right? So what am I missing here, Matt? Like, what are the planning opportunities around some of this? What are some things that folks maybe should perk up about when they hear these things?
I mean, the tax savings is a big one, right?
Mhm.
There's, I think, in my mind, right, the potential to consider, I'm not recommending this, but like if you're in that stage of life, maybe it's time to consider or look at the possibility of a Roth conversion, right?
Okay, can we just pause for a second? Everybody listening, I am smiling really big and giving Matt like a virtual high five because that was so well disclosed. It's like, I'm not giving you advice right now.
Yeah, it's a hard one, right? Because
It's
someone
hard.
wants to hear that and be like, "Yep, I'm doing it," and it's like,
Yeah.
"Whoa, whoa, whoa!"
I want you to explain what you mean in a second. We don't give advice on the show not because we're not capable, but because when we're speaking in generalities, right? It's not a one size fits all, right? Your unique circumstance, this may or may not be applicable. What I want you to do is instead, what Matt's about to say. One, kind of run it through the filter of, might this apply to me? And if so, do I need to get more information? Okay? So if you're like 35 years old, nah, not really that applicable to you, right? But
Right.
you don't have to be 65 for this to be applicable, but you might be. And so that's the thing that's really interesting. So you're telling me, Matt, that this senior deduction may change the math on
Right.
converting IRAs to Roth?
Sure. I mean, if they're going to give you an extra $12,000 of deduction, and then they're going to bump the other one a couple $1,000s, roughly 14,
Yeah.
an extra deduction. If you can convert, say, $14,000, right? Right there, you have a wash, and as long as you're not blowing your income up over that $150,000 threshold, well, it's like you could basically keep your income where it was from the prior year potentially, and
Can I, like, just for a second, when we get into these, for those of you listening, if you're wondering what we're talking about, so there's two kinds of IRAs out there, right?
Mhm.
There's what we would call a traditional IRA. That's the kind of investment where what you did was you put money into it before you pay taxes on it. And
Right.
now it grows and you don't pay taxes on it, but when it comes out, someday you're going to take that money out of the IRA, and when you do, that's when you're going to pay the taxes. So it's the compound interest, all the things the stock market does, but now that money, as it comes out to you, you're going to be taxed at that point. The reason we care about this is because in retirement, let's say that either you're taking money out voluntarily or you get old enough that you have requirements to take it out, and it drives your income up, and it's all going to be applied as taxable, and it's going to move your tax bracket up, right? I have more income now, I'm in a higher tax bracket. Roth IRAs behave a little different. You pay the taxes before the money gets put into it. And then everything grows tax deferred. And once it's qualified, and that means it's been around for 5 years and you're over the age of 59 and a half, that money becomes tax free. You know why that's a big deal?
Because it can grow for the rest of your life tax free.
Yeah, there's no required distributions on it currently. Heirs receive it tax free currently. And also because what Matt just said, if I understand this, Matt, and correct me if I get this wrong, is they just gave you an extra $12,000 of standard deduction. If you didn't make any more money than before, you could actually put $12,000 into a converted account, right? I can convert $12,000, and it's kind of a wash. I had $12,000 of income from the conversion, but I had $12,000 of deduction too. So it's like my tax position didn't really change.
Right.
Federally, I should say. Now, state of Oregon, that's not the case, but federal tax, that may give you the ability to do a Roth conversion, and that may get you to where your income tax is lower over your lifetime because you don't have required distributions in the future.
Right, and we've got this little window for 4 years.
Yeah.
And it's like they're giving you a chance.
Yeah.
Does the slipper fit?
Yes, and so this is where I think what you were saying is really clever. Like, if you're wondering, this is a good chance to reach out to a financial pro,
Yep.
and they can help you, right? And did we mention that we know these guys that specialize in retirement?
I don't know anyone.
Okay, I do.
Who? Oh wait, it's me. No.
Yeah. Oh yeah. No, Matt, you better be a retirement expert. That's what we do. Yeah, and so shameless plug, you can give us a call, right? And even if you're on YouTube or something and you see this, so we've got our contact information down in there, but so you call our office 541-375-0898. You can text that number too, and it's not a commitment to do anything. It's just hey, I'd like some more information, right? That's what that's about. Is you can get information from real folks that are going to try to take your personal circumstance into consideration. We are licensed in a lot of states, right? So if you're listening to this out of state, there's a good chance that we are licensed and have the ability to work in your area too. So I think we're still in every time zone. We're at least three. I think we're in every time zone in the United States. I don't think we have clients in Hawaii currently.
We're everywhere, all the time, omnipresent. Look at that.
Okay, we're overselling this, but no, we really do have, and plus we have Zoom, so we can work with you, right? If you've got a question, let us know. We can help. If you're overseas, it gets a little bit more complicated, but that doesn't mean no. It just means be aware that there may be different hurdles to jump through.
Mm-hmm. I like it.
Hurdles to jump over. I don't. You don't jump through the hurdle. I think we're doing it wrong, right?
Let me
the hurdle and through the hoop.
Something
Glad we
like
had this
that.
talk.
Okay.
Moving on now.
I have something for you to think about, David.
Go on.
I think what we're giving people is an opportunity here, because consider where we are in the year. We're only halfway through.
True.
Right? Like, this isn't the 11th hour where it's like it's the end of the year, you have 30 days to get this figured out. Like, planning can take time, right?
Yep.
Like, it's not an overnight, you come in, we've got your plan, you're ready to go the next day. This stuff takes time, right? Because there's a lot of things to consider. So,
but you have time. I think that's aren't you kind of saying,
I'm
we're at the
saying
halfway
both.
point.
Yeah.
It's not something that you should sweep under the rug or wait until the last minute, but I'm saying it's not too late to capture a lot of these things that this year they're going to start applying, right? This is happening in 2025.
Yep. So, before it's too late, imprint this in your brain. You have some time, but it's not unlimited, so you've got a little window.
Yeah. I mean, this stuff was signed into law on July 4th.
But look at us. We're being proactive and trying to get to it right out of the gate, because changes are coming, and when those changes come about, I think that's one of the big reasons why you have someone in your corner. Because
It's true.
Have you been reading the bill? We have to.
Yeah,
It's our job.
I spoke to my CPA last night, and we talked about how, well, he's going through primers on what's going on here, and so we've been doing our homework as well. Here's the interesting thing. I think that there are some things that are cool about this, but it was not nearly as earth-shattering as people were hoping. And while there are changes, and some people say, oh, there's big wins or big losses, I think there's a lot of phase-outs for whenever you said, oh, it's just a huge tax break for the rich. Here's probably the biggest, air quotes around tax break for the rich. It's probably in the accelerated depreciation category, and the way that they're going to allow some capitalization of research and development. There's going to be some of the two biggies is that companies can expense things in the year of purchase in many cases instead of having to amortize them over multiple years.
Well, I think the other big one is on the estate planning side. They're upping the federal estate amount per person from like what was it, 12.5 million to 15.
Yeah.
And so it's like, well, if you're married, now you get $30 million of.
And you know what's funny to me? While that is it's a pretty meaningful thing on a percentage basis, going from 25 million to 30 million. You're going, okay, it's an extra $5 million. That was about a 20% increase over the current.
Mm-hmm.
So there's
That's
a 20%
actually not
increase.
that much when you think about it as a percentage, because it's like inflation since 2020 has been 24%.
Yeah, so it's still a fairly large amount, and a lot of people may find themselves thinking, hey, that is, we're really letting rich people off. But what I would suggest is there's a little bit more to this picture, and if you really think about it in terms of like who does it catch and who doesn't it catch, the biggest people that lose when the estate tax level is pretty low are folks that have highly appreciated property. So, like let's say that there's a generational family farm.
I was just gonna go there. Yep.
Right? That like people literally lose the generational family farm because they're forced to pay huge estate taxes on the value of the land.
And
they don't have the money, so they have
yeah.
to sell the farm in order to pay the taxes. Right?
Mm-hmm.
So that's one issue. And then small privately held businesses.
Right.
And there are a lot of small businesses that they may employ a few hundred people, and you think, well, if somebody values that business at $100 million, well, the business doesn't have $100 million in cash. They're just saying, well, that business is worth that much if somebody was going to buy it. And I go, great, because you're going to have to make me pay taxes on $70 million at 46%, right? So roughly half of that. So that's a $35 million tax bill on a company that doesn't have $35 million. So when whoever owns it dies and tries to pass it to their kids, it's like, sorry, they have to sell it to pay the taxes. So that's kind of a bummer deal right there. Now, are there other estate planning things that yes, because you have to. But increasing that threshold somewhat does enable families to keep businesses in the family. And you do want to consider, like, it's easy if you are a person that's like, well, I don't have anywhere near that, so I don't care what happens to them. I go, yeah, I get it. You don't, because it's not really in your court. But do you want a scenario where the government can force people to sell stuff?
Yeah, like you build an empire only one generation later to have it completely wiped out.
And it's easy because you're like, well, the rich people should pay their fair share. To which I always go, okay, explain to me fair. Like, if you could give me what the definition is, but the fair is, well, they have more than me, then that's the part that's like, I don't know. Anyway, look, we got to grab our last break. All right, so
what are we going to talk about when we get back from that last break?
What are we going to talk about, Matt?
I don't know. I think listeners are going to have to hold on.
Okay, softest teaser ever. Stick around. We'll come back. We got a couple more things for you about the big, beautiful bill after this break. I'm Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 93.9 FM and 1240 KQEN.
I hate to break it to you, but we burned through all of our content.
No, we did not.
We did not. What did we miss?
Well, what we missed is that a lot of people are thinking about this bill and thinking, well, how's it going to change? And what they just learned is, do you know that there's a bunch of deductions that have always been available for you, and you weren't even taking advantage of those to begin with? Now that we put in front of you the fact that there's even more, it's time to look at what you've missed.
Give me an example of like what you talked about.
Like, most people are unaware that you, simply by participating in your employer retirement plan or creating an IRA, is buying a tax deduction.
Correct.
Right? So we forget the obvious ones. People forget, like, if I buy a home and I use a loan, the interest that I'm paying is tax deductible.
Mm-hmm.
Right? Where a lot of us have gotten to is, if the standard deduction is higher, we don't bother.
Justin was saying that this new bill kills off the EV tax credit, and we only have, I think he said, until the end of this year to capture that. Like, if you wanted to buy an EV and get the tax credit, you can do it until December. So that's another one. It's like, if we're trying to be timely, you might.
Well, and those are some things that will sunset. If you're not going to get the credits anymore, then so be it.
Do you think we'll see Tesla's sales jump on that news, where it's like, the EV credit?
I don't know. Tesla's been politicized a lot. But Tesla's doing some other stuff that I think is really kind of relevant too. I think the driverless tech is a big deal. I think that, with traffic problems in really highly congested urban areas, the idea that AI could integrate with Tesla and then drive the cars more smartly than humans, you could really reduce traffic problems at rush hour if you didn't let people touch the steering wheel.
Did you see that Bezos has a company that he's backed heavily, and they're releasing this year or the start of next year an EV that MSRP's for like 20 grand?
No?
Yeah.
So it's like a hopped up golf cart?
It's wild. It's like either a truck or an SUV. It's kind of like the old 90s Broncos, but it's cheap. It has like a 150-mile range.
Well, that's better than, I don't know. All right, welcome back to the True Well Show. We do this on the last segment, so we get to talk about what are we going to cover on the last segment, and then we're like, oh, you're on. It's like,
Yeah,
okay.
We go down a rabbit hole.
Okay, so here's the final rabbit hole of the show, right? Big Beautiful Bill brings back creates new tax deductions, and Matt says, well, what else we can tell them? Well, first of all, how many people forgot that there were already tax deductions that are still available?
Right, there are a few.
Okay, and so there's still a tax deduction for retirement plan contributions for your employer in most cases.
Mm-hmm.
Okay, there can be tax deductions in certain circumstances for IRA contributions. Roth IRAs are not tax deductible, but they're still interesting. If you do not qualify for a deductible traditional IRA, you may still be able to create a Roth IRA, even if you're ineligible. That's one of those where I'd say, see Matt after class. See
Yep.
how I just gave you extra work?
I appreciate that.
You're super welcome.
I'm just stoked.
So, one thing, you brought this up, and I think it's interesting, not everything is like a give in the bill. There's some takeaways, right?
Mhm.
I think the big one, this has been, can I say this on air? There's been kind of a pissing match lately between Trump and Elon Musk, right? Both of
True.
whom have become like wildly popular amongst internet trolls.
Yep.
So, what did we lose here? What will we
Well,
lose?
we're losing that EV tax credit, and I forget what Justin said on the date. I think it's at the end of the year, right?
Mhm.
And so it was a pretty big
It's
deduction.
like $7,500, isn't it?
Yeah.
Isn't it a tax credit too? I think it's a tax credit.
Actually,
and-
it was a tax credit, not a deduction.
So just so everybody's aware, they're not the same thing. A tax deduction is, hey, I had $100,000 and I had a $7,500 deduction. I show as if I have $92,500 in income. Okay.
Mhm.
A tax credit is, I had $100,000, I paid my taxes and I owed $30,000, but I got a $7,500 tax credit. I only had to pay $22,500 in
That's
tax.
actually more powerful.
It is. It's like a dollar for dollar reduction in your tax.
Yeah,
so
that's
it's
a big
better
deal.
than a deduction. A
Yeah.
credit is more powerful.
Yeah. So might be a good time potentially if you wanted that Tesla, right? Like,
Yeah, it's
or
probably
whatever.
it's sunsetting, and so that's probably true. And it'll be interesting to see how that is
But-
handled.
There are income limits to get that tax incentive. So.
Yeah. So anyway, it really was going to be interesting to see how the current administration and electric vehicles move forward. I still think that there's some pretty significant use cases. To me, it's the fusion between driverless vehicles and artificial intelligence that is really going to be a compelling story for our future. You know where it will be really interesting?
Where?
Portland and Seattle.
Why Portland and Seattle?
Okay, I'll do this really quickly because it's at the end of the show. Portland and Seattle are really interesting test cases for me because both of them have rivers and mountains all throughout, which means that they are topographically restrained. It's really hard to put new roads in place and to manage traffic, and they have high population density, which means during rush hour, it's really hard to smart route traffic because there's not enough places to put roads in the first place because of the geography and the topography.
Okay.
So if you look at those constraints, then you go, how do you plan for traffic routes? And I'm not a traffic engineer or anything like that. I could just sort of see this and go, really? And my solution is, well, what you do is you tell drivers who keep making mistakes and being stupid, you're no longer allowed to touch the steering wheel. AI is going to take over within certain boundaries of the city, and it's driving the cars instead. And it will smart route traffic, and it will not jam the same way, right? Because humans just make unforced errors, have accidents, have stuff go wrong, where AI's like, no, we're going to root around this and be smarter, and we're not going to let you cut somebody off to try to save 10 feet and have bad behavior, right? You're going to be stuck in the lane, and you're just going to wait your turn, but it'll actually be faster.
Interesting.
You know, because it forces cooperation instead of some people being advantageous in offense and while other people get taken advantage of, right?
Watch it get smart, and there's like some connection with the government where it's like, we're gonna take you through all the tolls on your way home. Where it's like, oh gosh,
Well,
all the toll fees.
That would be something, although I would think that the government could simply tax you per mile if it knows that you're in a driverless
already
vehicle.
happening.
Yeah,
right?
yeah.
Like, that's already been proposed as legislation where it's like, well, these darn EVs, we're gonna make sure that they pay per mile, and it's like, whoa.
Yeah.
Like, imagine being
well, and if
tracked.
you're like, well, look, as long as there's no more gas taxes and you can't charge me registration taxes and other stuff, you know, it'll all get sort of ironed out. But I'm just saying that is a solve,
It is.
right?
No, it is.
And I would even argue that, you know, you get taxed per mile and you're grumpy about it, but if you get back like a week of time over the course of a year because you're not sitting in traffic for a week, right?
Yeah.
It might actually be worth it.
Well, think of all the energy savings if you're not sitting in traffic and
Yeah.
burning up electricity or.
Well, and think
fossil
about it. You
fuels.
could watch Netflix and chill because somebody else is driving. So there you go. You can get started early.
Oh, man.
Anyway, so there you have it. There's our primer for the one big beautiful bill.
'Kay.
And just a reminder, you got time to do some planning. And Matt, let's say that somebody said, yeah, you know what? That's a good idea. I ought to reach out. How can they find us?
Yeah, why don't you go ahead and maybe call us or text us at 541-375-0898, or you can even email us at info@littlejohnfs.com.
Okay. Those are the easy ones. If you go to the website at littlejohnfs.com, there's a lot more you can learn about the firm, kind of get a sense of what we're about, what our values are, and what we're trying to do. But again, our path is pretty simple. We want to help people get retired and stay retired.
I like it.
Okay. So as I look at the clock in the final, 30 seconds, you know,
More deductions, more smiles. Life is good. Carry on.
okay. Well, I think that's pretty much it for the story. So you know how to reach us, and you know what the big beautiful bill's about. Now, I think what you need to know is quit in time, and we're gonna send you out of here with style. So thanks for tuning in, and
Just say
until
Little
next
John
time.
Financial a bunch of times over.
Yeah, no, just give us a call later. You've been listening to True Wealth on News Radio 92.9 FM at 1240 KQEN.
Little John Financial. Little John Financial.
No, just
Remember it.
all right. Can we turn it off?
All done?
All done.
Done streaming?
Then you have to reach that one. You're the tall guy.
It's gonna shock me. Did it shock you?
No.
Real close.
Really?
That's just
Every
gonna take
time
pictures.
I turn that thing off,
Another
it's just
button.
zapped.
You're close.
Where at?
You're zooming
Now
in.
I'm just zooming in.
My goodness.